Yep, we're still talking about Germany today and their plans to move their gold from Paris and New York back to Frankfurt. This time we'll get John Nadler's point of view. He's up next. We got tons of emails on this topic. Stay tuned. John, let's get started. Thanks for being with me. Let's talk about Germany. Are they going to be coming in with wheelbarrows to get their gold back from New York and Paris, bringing it back to Frankfurt? We brought up this topic yesterday on the show with Peter Hugg, and I got tons of emails to the point where people were even alluding to the fact that I was part of the conspiracy and how they find it odd that we didn't question the fact that this process is taking place over a 7-year term. So, John, I'm going to throw it to you today. Do you think that it's odd Germany, A, wants to bring the gold back to Frankfurt, and B, that it's taking place over this 7-year term?
Look, the German central bank had ample reason throughout the decades to keep a lot of its gold outside of the country. After all, it was facing, the threat of the Cold War and potential, hijacking of its gold holdings. So the fact that it has kept sizable amounts in the United States, in London, in France, and so on, and that eventually the public demanded at least a portion of this gold be brought home, that's really what the catalyst was for the central bank to begin a process whereby they reevaluated how much spare capacity they have in the country for storage, and how much they should bring home. Look, out of the New York holdings, only 20% are being returned over a period of 5, 6, 7, 8 years. So how can this impact the market? It cannot, it will not. I think what we need to look at are some of the words that come from actually a German, Commerzbank's Carsten Fritsch, who basically said at Deutsche Welle this weekend that although Germany's holdings of 3,400 tons are, sizable by all means, certainly the second in the world after the US, they're little more than symbolic value to Germany, especially in light of the fact that Germany has an outstanding euro large sovereign debt of about 5 trillion. So as far as the gold tonnage, that's not especially large when viewed in the context of Germany's sovereign debt. Certainly also not in comparison to how much Germans as individuals hold in form of bullion, which is estimated to be as much as 7,500 tons of metal stashed in German mattresses. But most importantly, I think Mr. Fritsch launched a broadside against the, conspiracy theorists out there who are bandying about these fatally flawed arguments that somehow this move, this repatriation, represents some sort of distrust of the Fed, fear of the U.S. collapse, or in fact that it's a test of some, missing gold somehow.
I guess that's the main point here, John, is does it show a breakdown in the system? Does it show a lack of trust in central banks? I guess the question is, how much space is this gold taking? Is it really necessary to move it?
I think in the first place, if there was a lack of confidence issue here, we would see 80% of the gold move, not 80% left in place at the Fed, first and foremost. Second, let's listen to reality, which tells us that in part, the German population's clamoring for return of the gold was in fact partially the Bundesbank's own fault, because for years they didn't conduct any recurring audits of these vaults where they stored the gold. But to go from there and say that somehow, Germany was denied access because the gold wasn't there to begin with, because it was leased out and what have you, this is complete and utter nonsense. In the words of the Bundesbank's own board member, Karl Ludwig Thiele, who spoke at a press conference in Frankfurt just a few days ago, he said, absolutely not. Everyone and everywhere welcomed us with open arms. We saw the inventory, we inspected individual gold bars, and then we cross-checked them against the lists. And that, to me, Daniela, sounds like an open and shut case. This story needs to die a natural death.
So let's look at that 7-year term, John. Some finding this the suspicious part. Why 7 years, and who decided this?
Well, I think ultimately, if the Bundesbank decided what percentage goes out of what location, and I could give you the example that in fact in France they're basically cleaning out the vaults, then the Bundesbank must be the one that decided on the time frame, on the methodology of the transportation. Certainly the logistics are not going to be disclosed to you and me, obviously for security reasons, and the amount being stretched out over this many years is basically what suits them. They probably want to fill those vaults on domestic soil in an orderly fashion, and that is all there is to it.
John, do you think it's a question of just bad timing? Should Germany have waited to make this announcement, especially with all the troubles that are happening in Europe?
No, I don't think there was any reason to wait. I mean, at this point, I think that they saw the basic threats that put the gold at risk in the first place. I named the Cold War. The European crisis is behind us, by and large anyway, but not fully. They had to cave in to public pressure to bring part of the gold home, especially since they had spare capacity inside the country. And this means really nothing in terms of transparency or gold price effects and what have you. It is simply a reshuffling of assets in terms of storage location. And I'm sure many a country has done this in the past and will continue to do the same.
Moving on, John, moving on to India and gold news over there. The Indian government enacting a 50% hike on the duty being levied on imported gold. It will rise to 6% from 4%. John, could this hurt gold demand?
The move isn't surprising. I mean, we've heard rumblings of something has to be done about the dampening of Indian gold appetites for months now, really. The Indian government basically recognized the fact that after crude oil, gold represents a huge current account deficit problem. In fact, the estimates are that, certainly on Bloomberg News, I saw a metric that said that 80% of India's current account deficit is in fact owed to the large gold imports in previous years. So clearly the government, in its quest to address this yawning current account deficit, is implementing measures that it believes will dampen appetite for gold specifically. So they raised the tariff to 6%. That's a 50% hike. We saw premiums, of course, rise quickly in advance of that because people try to stock up before the legislation went into effect. And I think it's rather early to conclude that this may or may not lead to, increased smuggling or may not lead to decreased demand. The bottom line is that India last year in March already doubled the tax on the purchase of gold bars and coins in order to do the same thing, namely to discourage that much demand. And of course, what we saw is that overall Indian gold demand did in fact fall 28% in the 12 months period that ended in September of last year.
John, let me ask you, why would the Indian government want to dampen gold fever? Don't they want people buying gold?
In as much as it contributes to the swelling of the current account deficit, clearly not. They would rather do anything else that would perhaps mobilize some of the 20,000 tons that are estimated to be stashed under Indian mattresses. They would rather that people certainly, go out and buy equities or what have you and support the domestic economy rather than plow money, cash, into what is seen a non-productive asset and put it under the mattress, basically taking it out of circulation. Mind you, Indians had reasonably good, cause to buy gold in these previous years because the rupee was declining, inflation wasn't, all that tame. But the bottom line is that they ended up hurting their own country by swelling its current account deficit. This is exactly what the government is trying to address here.
John, let's look at Sachs and the Citi, as you so cleverly penned today. Citigroup announcing that they scaled back their gold forecast to $16.75 an ounce for 2013. Goldman Sachs, looking at a gold call of $18.25 per ounce. This is over the next 90 days. So two different forecasts here. John, thoughts?
Yes, some thoughts. I think we need to put both of these projections into perspective. Certainly, Citigroup scaling back to $16.75 per ounce, I believe it was. That's about a 4.5% scaling back of previous projections, is largely the fact that they have seen gold, struggling recently, certainly at the $1,700 level several times. And then, of course, at the previous high around 1,800 and such, they have concluded that, in fact, there is some sort of loss of faith among investors in the bull story for gold. Certainly, if you look at net managed money positions on COMEX, these have dropped 50% since October of 2012. And we see, not that much growth in ETFs.
So, John, is that what we are hearing, that ETF demand is stalling?
Well, what Citigroup was tracking here was that positive inflows for exchange-traded fund investing, and that's a very important gauge because the gold market, as we know, has been very much over-dependent on this niche to sustain itself. They've also stalled. Since October of last year, we've seen about 17 metric tons of redemptions so far in 2013. So I think Citigroup is also looking at that tracking device as one of the gauges of why they said that there's an apparent loss of confidence in this. Interestingly, Goldman, while some people don't see a value in a long-range forecast that extends out to 2018, Goldman's prediction of $1,200 gold by that year is based on the fact that they see interest rates in the U.S. normalizing, certainly up to at least 2%, some people even say 4%, i.e. the Fed will exit from an environment where we have negative or zero or very low real interest rates. And that is key for the gold market.
John, final topic of the day, silver coins. Do we need to run out and hoard them after the U.S. Mint announced that it needs to halt sales of its 2013 American Eagle silver bullion coins? My question to you is there a silver shortage?
Absolutely not. And I would remind our audience that we've seen this movie before. It's suspension in sales have happened in previous years, and the Mint did resume sales, as of course even last week's announcement to its primary distributors noted that sales will recommence on the 28th of January.
John, you mentioned to me offline that there's actually a surplus of silver of 207 million ounces. Is this correct?
Yes, actually, according to the latest estimates, that's the size of the overhang in the silver market, and it's fairly sizable, and it's a quantity that needs to be absorbed one way or another, either by ETFs or by physical purchases, or else we have a price problem. And silver has been in a surplus mode really for the last half a decade or more. So that's not a secret. There's absolutely no shortage of raw material from which to fabricate these types of coins. It's simply a question of fabrication capacity, and I think that'll return to normal as it has before too long.
So, John, we won't see this stampede of people running out for silver.
Not unless silver shoots back to $40 or $50 and everybody starts chasing silver as they did a couple of springs ago.
John, thanks for your thoughts today. We'll see you soon.
Thank you. We'll see you soon.
And thanks for watching this edition of In the Lead. You can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.